On March 6, 2024, the SEC adopted rules to require the disclosure of certain climate-related information by public companies and in public offerings. The new rules require companies to disclose material climate-related risks and their impacts on the company, certain financial statement disclosures related to severe weather events and other natural conditions, and certain greenhouse emissions, where material and only for larger registrants. Companies would be required to disclose climate-related risks that have materially impacted or are reasonably likely to have a material impact on their businesses. Climate-related risks include both physical risks and transition risks. Examples of physical risks would include impacts of hurricanes or sea level rise. Transition risks, on the other hand, relate to a potential transition to a lower carbon economy. Examples of transition risks would include risks related to a reduced market demand for carbon-intensive products. With respect to greenhouse emissions, the new rules use the Greenhouse Gas Protocol's scope concept, which classifies emissions into three categories, or scopes. Scope 1 emissions are direct greenhouse gas emissions from a company's operations. Examples include emissions from company-owned machinery or vehicles. Scope 2 emissions are indirect greenhouse gas emissions resulting from the company's use of electricity. Scope 3, which are not required to be disclosed by any registrant, are all other indirect greenhouse gas emissions not accounted for in Scope 2. Smaller reporting companies, or SRCs, which often have limited resources, and emerging growth companies, or EGCs, which are certain newly public companies, are exempt from reporting any of these greenhouse gas emissions disclosures. While smaller reporting companies and emerging growth companies are exempt from some of the disclosure requirements, other requirements do apply to them. Those requirements include certain disclosures about any oversight by the board of directors of climate-related risks and any role by management in assessing and managing material climate-related risks. Any climate-related risks that have materially impacted or are reasonably likely to have a material impact on the registrant. Material expenditures incurred and material impacts of registrants' activities to mitigate or adapt to climate-related risks. Any processes the registrant has to identify, assess, or manage material climate-related risks. Any targets or goals that have materially affected or are reasonably likely to materially affect the registrant, and the financial statement effects of severe weather events and other natural conditions. Registrants will need to comply in annual reports and registration statements on a phased-in schedule. Large accelerated filers will need to start complying in filings containing disclosure for the fiscal year beginning in 2025. Accelerated filers, other than smaller reporting companies and emerging growth companies, will need to start complying in filings containing disclosure for the fiscal year beginning in 2026, and smaller reporting companies, non-accelerated filers, and emerging growth companies will need to start complying in filings containing disclosure for the fiscal year beginning in 2027. This video is intended to provide only a high-level summary of the new climate-related disclosure rules. As always, we encourage you to take a look at the fact sheet and adopting release for more information.